Hi, everybody. This is David Skarika. So this is a podcast or video cast, Zoom interview, what do you ever want to call it, with Mike Swanson. I just want to move my thing here so you can see my sign. But anyhow, yeah. So what we kind of want to talk about here is something a little different. I know Mike and I talk about markets and trading and investing, and I do a lot of junior mining markets and or trading in general. But what we kind of wanted to talk about today was something a little different, something that I've talked about a long time, actually, and what got me interested in finance, economics, the markets, and because we've seen this back up in yields recently, and the spin is always, oh, yields are going up because the economy's strengthening, but Mike and I believe that yields are kind of going up because you've got all this printed money, inflation, and debt out there, and now the yields are going up because there's worries over these things kind of being like unsustainable. So just before I start, I just want to just explain my history with this sort of thing. How it got me like interested in the markets. And the funny thing is, and this was back in the early '90s. I was born in '77, so I was like a teenager, and I started reading these books. My uncle gave me a book by James Dale Davidson, which I'm going to show you in a second here. And then it was all about the welfare state ending and the governments becoming too indebted. And it's kind of a joke now. Not the book was a joke that everyone was so worried about this. Back then, just because now it's gone on for almost 30 years, and now that the debt back then in the early '90s, I think was about 4 trillion. Now it's almost 30 trillion, and going to be 30 trillion after this next 1.9 trillion stimulus is spent. That no one cares, even though the debt's 7-8 times higher than it was, 30 years ago. So, anyhow, so this was the book called The Great Reckoning by James Dale Davidson, and it's worth getting. You can still get actually new paper books, and hardcover is actually only $11. So you could get that right on Amazon if you like. And they talk about past debt crises, and they do a long-term kind of historical kind of analysis of a lot of these empires that failed and the whatnot. And the other one, which I have here in front of me, which I talked about the other day, I'm going to show you that in a second too. Bankruptcy 1995 was written by Harry G. Figge. And actually he has something that he calls the hockey stick chart in it, which is when the debt kind of goes parabolic and blows off. And he talks a lot about also in that book about the hyperinflations in Latin America in the 1980s, etc. And if I go look at that book right now, yeah, here it is. You can see, you can get this book for almost nothing. Actually, it looks like, but you can see 88 used. You can get a used version of this book for, $1 or 30 cents, So if you really, it's worth the read. And I think I got this one used actually for like $1 or 30 cents or something like that. Yeah, so these are the kind of things. And like I said, I think the ironic thing, and this was the early '90s and these were written. If you remember in 1992, when Ross Perot did very well in the US election, he ran. This was one of his big policies, that the national debt was out of control and the country was going to go bankrupt. So the thing I kind of find ironic about all this, and by the way, because I was so worried about the debt and inflation and this sort of thing at the time, that's how I became interested in gold and precious metals. So anyhow, what's kind of interesting though with it is that now the national debt is so much higher than it was back then. I'm going to show you some articles, but it's going to get you a chart here just to show you. You can see this chart goes all the way back to World War II, when it spiked to 120% of GDP in the war effort, and we're basically back there. This is actually the gross. This doesn't really include last year, so we actually are at 128%. We're actually above where we were during the war. So even though in that early '90s period it was getting to about 60-70% of GDP, and people were worried about this sort of thing. Like I said, even a presidential candidate, who got the double digits of votes percent-wise in the United States, and almost carried a few states. That was one of his main, policies that he ran on. Now we're here, and because interest rates have been suppressed and gone down due to QE and central bank actions, no one even cares. Actually, we're talking about more stimuluses, just another 1.9 trillion passed. We're talking about, stimulus, in terms of infrastructure, Green New Deals. We're talking about the government spending more because rates are so low. Now, the one argument is we could end up just being like Japan, and because of, this kind of low growth, low inflation, deflationary situation they've been in, they've basically had rates at zero, and the debt to GDP there is 250%. But I don't think it's going to be like that. There's numerous reasons I'll get into in a bit. But anyhow, Mike, so I just wanted to talk about this, and this plays into the market because I think this is why a lot of the inflation plays. Your commodities have been going up in price. Interest rates are backing up. I think it's fears over this debt now becoming unsustainable. I'm going to quickly, while you talk, actually, I just opened it right to this is, actually, no, 1 second. That's actually not it. But I just want to quickly look for what he talks is that, right here. So this was the debt projections that he had back in the early 90s in his book. And he called that the hockey stick chart. So basically this said that by 2000, the national debt would be 13 trillion. At that time, it was about 3 to 4 trillion when this book was published. Now it's almost 30 trillion. So anyhow, it's just funny that you've seen this big parabolic move in debt, and now nobody cares. Like, you don't hear anybody talking about the debt being a threat to the economy or national security, etc.
Well, it's funny you showed briefly this Wall Street Journal article that just came out.
Yeah, I'll put that up right now.
Saying that the debt's going to go up to 200% by soon. And several days ago, the Wall Street Journal held a event with Jerome Powell, the chairman of the Federal Reserve. A reporter was asking him questions. And over the past 2 weeks, we've seen some movements in the Treasury bond market that have caused stock market volatility. And that's causing people worries. And there were rumors a weekend ago that maybe they would do Operation Twist. That would be where the Fed would sell short-term bonds to buy long-term bonds to try to prevent any of these movements from happening again. And this reporter asked Jerome Powell if he would do it. And Powell said, no, that's a hypothetical need and we don't need it now. And then the reporter obviously he wanted a different answer. So he asked again and he got the same answer the second time. But what it shows me was that this reporter has absolutely zero worry about the issues you're talking about. And all he cares about is any action that could make the stock market go up. So I would say that may be one reason why there's not much worry about it, because most investors, they just want the stock market to go up and they don't want to worry about the national debt. And they might tell you, look, the stock market goes up, it makes me money. And you're telling me to worry about something that some guy wrote about in 1995 and everything's okay. And I just want the market to go up.
Well, and also it's just that in terms of the QE, money printing, to buy debt. Remember when the financial crisis happened and they did QE, they didn't really do it to suppress rates per se, because rates were suppressed. And I think there was demand for government bonds because everyone was scared and just wanted safety. But I think the reason they did it was actually to push people out of government bonds and make them buy corporates, lend money, speculate in the stock market, because they wanted people to take risks again because risk taking is what essentially, be it, lending someone money or using that money in venture capital to invest in a new technology, new company is what makes the economy grow. Or, taking that money and, building a suburb, and selling the houses. Like, that's what makes the economy grow. Like, not people just like hiding money under the mattress or buying government bonds with it. But I think this time around, they're really going to have, so I think because of that too, people also think, oh, they can just buy it and buy the debt, right? And now just because they did it 10 years ago. And but I think too, the debt levels are so much higher, it's more dangerous now. And then also I tell people, hey, if they can just do QE infinity and buy debt and suppress rates and do MMT and fund all these spending programs, why the hell do we even pay taxes, right? Why don't you just get the Fed? Why don't you just get the government to spend $5 trillion a year, not collect any taxes, and get the Fed to print all the money and basically, fund the government, right? So,
I got to show you something crazy. I got to show you something. I forgot all about this. Telling you this. Can I share my screen for a second?
Oh yeah, I got to allow you to do that. Give me a second.
I got you. I haven't.
Let me give you the permission.
I haven't sent this to you. I got to show this to you. It's on this topic.
1 second. I got to 1 second. Yeah, I got to more. How do I do this again? No, I'm not going to. I'm going to stop share. 1 second, because there's a way I have to do it to give you permission to do it.
It's the only one thing I want to show you. Then it will take a second.
1 second. This is the.
Well,
okay, perfect. I just did it. You're good now. You can share the screen.
Okay. Someone sent me an email. I get all kinds of stuff, and this was a brokerage report from an investment advisory company or something called Northern Trust.
Yeah.
And it says that, look, what we're talking about, even if, what's obviously happening is bonds have been falling in value, and most Americans are invested with 50% or 40% of their money in bonds as a safe haven. And since the 1980s, whenever the stock market has dropped, these bonds have gone up. So they've helped them weather the storm. And, but if what we've been seeing over the past several months is this hasn't been working. Bonds have been falling. Even when the stock market has been falling. And what the implications of what you're talking about is this is just going to continue. And this article says this is a risk, this is a problem all investors have, and but we have a solution to it. And their solution is they say, look, you can't really make any interest on bonds anymore, treasury bonds and high-grade corporate bonds. So what we can do for you is just get you in riskier bonds that pay bigger yield. And that's their solution. so that's just to be really crazy, but that's your option. We'll just pick out some more risky. Well, they're not even use the high. I don't know if they use the word risk, but high alpha bonds and higher yielding bonds and phrases like that. That's what they say.
Well, and then what this does is this forces people into these junk bonds. Like, for example, junk bonds right now, the JNK or the HYG, they only on average, actually, I'll even look at the St. Louis Fed yields, St. Louis Fed. So we'll put this on right now. You'll see this right now. Yeah, you can see they only yield 4.5%. And here's what's interesting too. We'll talk about this in a second with the market rolling over and the whatnot. Now we're talking about government debt here, but there's also a corporate debt bubble, which we'll talk about in a second. But you can see like this is almost like an all-time low. Like the max chart, you can see actually this is an all-time low. This is lower where it was in the 2000s, where it was like a few years ago. This is the all-time low in junk bond yields, right? And that's what people are doing. Like this article saying is that, because I'm only getting 1.5% of my 10-year U.S. Treasury. And at one point it was 0.5%. I'm going to go buy these junk bonds, and I know a junk bond I should be getting 7 or 8% or 10%, but now I'm willing to only get 4.5 because rates are so low. So that's kind of what's happened. But the interesting note is too, well, we're talking about government debt, and because the government debt is now so high, this is the famous website here, the U.S. debt clock, which shows you 28 trillion. It's really 30 trillion because that 1.9 trillion, which was passed in the Senate yesterday, that basically gets tacked on that 28 trillion. So, but anyhow, because it's so high now, granted, the Fed does own some of it. So it's almost like the government's paying itself interest, because when the Fed owns it, they pay the interest out to the Treasury. So it goes right back. But still 100% of GDP of this is owned by the public or foreign investors or whatnot, right? This is so high now that I think that the thing I saw was that if for every 1% the yield goes up, so that's the whole curve. So short-term rates basically go from 0 to 1. The 10-year bond goes from 1.5 to 2.5, right? For every 1%, that's 800 billion in interest, right? Well, the government budget, you can see, look at the tax revenue, the government collects about 3.4 trillion in a year. So 800 billion is like 25% of what they collect in revenue a year, right? So if rates were to go up 2%, that's 1.6 trillion. That's almost half of what they collect here in taxes. So they can't afford it anymore. And that's why they have less leeway. Almost like maybe the last QE was to keep investors aggressive, speculating. This QE, I think, is going to be to keep the government from going broke, essentially. Because, yeah, if those rates go too high, that's what essentially happens. Actually, one thing that Figge talks about in the Bankruptcy 1995 book is he has a story. It's like a fictional story at the start, and like one of their the fictional family in it. Well, I think one of their kids gets injured because a bridge collapses, and the bridge collapses because the governments are all broke and really can't afford to fix this stuff anymore. So right now we're talking about, oh, they got to give everyone $1,400 stimulus checks. What happens if the government can't afford, to give people this stimulus money and the whatnot? So that's kind of, the real risk there. And like you said, that 60-40 bond thing is also really important, because ever since the early 80s when equities ended, really, even with 2009, it's really been a massive 40-year bull market, right? Ever since they entered that, there's been this trade where rates go up while stocks go up. So, and then the bonds go down, stocks go up, and vice versa. When you have these bear markets, there's the flight to quality, and rates go down in government bonds. So your bonds are going up in price when yields go down, while stocks go down, and your stocks are going up in price while bonds are stagnant. So you have this trade where you're kind of hedging yourself. Well, what happens if we go back to the 70s when rates went up and stocks went down, right? Bonds went down and stocks went down, essentially. So that would totally destroy that whole, financial theory that's been going on since the 1980s,
Yeah, well, a year ago, New Year's 2020, I had about 50% of my money in treasury bonds and CDs. Now I have zero in them. Zero.
Yeah. Well, yeah, that's it. Because why would you have them, right? So anyhow, so there's numerous factors. So another factor here too is there's also a corporate debt bubble. I'm going to show you this in a second. So you're going to see this corporate debt here. Again, and you can see and notice this huge spike last year. Let's get you can see World War II, it was nothing. It was like, I'm just laughing about how low it was, and then and now it's just it's just exploded, and then actually usually like in a recession, which you can see here, like in the mid 2000s after the .com, kind of flattened out for a bit. But this time around, the corporate debt bubble boomed because companies, actually the Fed was loaning them money and using these you can see right here, right, in the first, second quarter, it boomed because companies were essentially going on borrowing sprees to shore up their balance sheets while this occurred. So I just want to that's a 10-year. Let me get something more so you can really see it. 1990, yeah. In 1990, corporate debt was essentially just over $1 trillion, and now it's over $7 trillion. So you can see they've been on a borrowing spree as well. And what's interesting about corporate debt is, let's say the government bonds do hold up for a little while longer. Again, there's another decline in the markets. People go to them as a flight to quality. Look at the yields of the high yield bonds back, in the 2000s. You can see during the year that was when the tech bust started, there was a little spike here. And then notice what happened in 2008 and what happened last year. So when government bonds tanked to like 0.5% last year, the junk bonds went from just over 5% to 9%. So what will happen probably if we get another tank is that corporate bonds will probably decline, even if the government bonds hold up in the short term in any kind of bust,
Hey, can you show what it did? Can you go back further to like the max and go to the 70s or something?
Yeah, no, it did. I think this when I loaded it up, it was going back all the way to 1945. So now it's not doing that. One second, let me go back to that. Oh no, that wasn't the yield. That was just the debt. Yeah, the yield only goes back to 1996. Well, let me check investment grade bonds.
I'm just curious.
Corporate bonds. Let's see this here. 96. Now, most of these things go back as like early 80s. I can just look at the dates on all of them. So, that's too bad because I would like to see that too. The only other thing I can see is there's a great website called Trading Economics. Let's go look at them. Let's go look at this here. Let's get the max here. Yeah, here you go. They're the corporate bond yields in AAA bonds or investment grade bonds.
Well, it appears to me that one of the most important factors in everything right now, and I'm not trying to say, I don't know all of the scenarios laid out in those books you mentioned, but regardless of how this plays out, it does appear to me that we've hit a secular low in all these yields last year. And the last time that happened was in I guess the 1940s.
Yeah, and I think in the 40s, this corporate bond only goes back to looks like about 1960. But yeah, I think in the 40s, it was about 3-4%. I think the A-rated corporate bonds. Actually, I'm going to tell you something really funny in a second on top of this. And then you can see it slowly went up in the 60s, and then the 70s, it really spiked. What's funny is this says AAA. This isn't really AAA, and I'll tell you why in a second. It's just investment grade bonds. Because there is only one corporation left in America that has like a AAA rating. I think it's is it Apple? I think it's like there's one. But what's happened is there was a whole in the early 80s when rates you can see in corporate bonds were like 12, 14, 15%. There were dozens of corporations that had AAA ratings. But because they've used these low interest rates to all issue so much debt, I think there's only like one or two left. It might be Microsoft. It's either like Microsoft or Apple. It's like one of those two. But like most of these companies are AA rated now. But that is how crazy. And it shows you the lower rates haven't even helped these companies' finances because they've all been downgraded to not AAA anymore because they've took on so much debt because rates have been so low for so long. And look, Kyle Bass has a theory that what happens to people's psychology is they think whatever happens the last year or two is they're going to continue indefinitely because that's kind of how far their memories go back. Well, when something's been going on for 40 years, you can really see why people think that like it's never going to, never end because, these corporate bond yields have gone up down for 40 years.
Well, that Northern Trust article that was recommending that people get into higher yield debt as a solution to the fact that you can't make anything on bonds. They did a back test to prove that this is still a good strategy, but their back test only went to like 1980. They don't show you what it, that's the people just, and that's how, what all investors remember is what's happened the last 2 decades, since 1980. And they don't remember the 40s to, to the 1940s to 1980, in which that would have been an awful strategy. So it's sort of what you're saying.
Well, here's what you're talking about. This is the 2-year high quality, so basically investment grade corporate bond rate, average rate since, they're going back, since the mid 80s, and it's 0.37%. And you can see in the early 80s, it was like 13%. This is just a 2-year bond. So you're getting essentially nothing on these short-term corporate bonds right now, right? So, and like you said, this probably went from a few percent in the 40s to that 14%. Like you said, that would have been a terrible strategy. And I'm sure in the early 80s, no one thought corporate bond yields would go down because that essentially had been a 30-year bear market in them, going back to the late 40s, early 50s. And now it's exact opposite. We're in this kind of long-term bull market in bonds, downtrend in yields. So no one really thinks that they can go, any longer or any lower, So
yeah, I think all this symbolizes that we're heading for a much different macro environment.
Yeah,
any of us are used to, and it's just going to start to change.
Well, and then the question is too, see, and this is where, now we can kind of get into the inflation side of it, where if, let's say, the U.S. Treasury goes to 2 and 2.5% on the 10-year, I think that's when the government starts getting into difficulty financially because too much will be going into interest payments, right? I think that's when the Fed could start to monetize and do yield control, buy in the long end, a part of the curve. And I think, and that will be massively inflationary because you're essentially going to be monetizing the debt to keep the government solvent. If you read what happened in Weimar, Germany, what they were doing is they had to pay back the loans from the Versailles Treaty in gold. So they were just printing money as a mark to value because it took more marks to buy gold because gold, was basically linked at a certain price back then. But of course, it took more marks for it to buy it as the mark fell. So that's essentially what could be happening here with the bonds. As the debt goes up, they're going to have to issue more money, print more money to continue to buy the debt. And then it has to go down afterwards, I mean, I'm saying that like they have to, so the yields can stay low. So it almost becomes then this vicious circle. We have to print more money to buy more debt to keep the rates low, and you need to keep the rates even lower because if that Wall Street Journal article comes to fruition, the national debt goes to 202% of GDP, which means right now, if it being 30 trillion, the economy will grow in the next 30 years. Let's say that means it's 80 trillion. Well, they're going to have to print even more to keep that 80 trillion at a certain yield so it doesn't bankrupt the government. That's essentially what Japan's done. But here's the advantage. When people say, hey, Dave, Mike, how come it can't just be like Japan? How come it just can't be like, oh, go monetize the debt. We'll have this low growth environment. But, whatever, we won't have massive inflation. The currency won't tank. The yen hasn't tanked. The issue, the positive that Japan has a big current account and trade surplus. So they can kind of subsidize some of those fiscal deficits because they produce so much and export so much. The U.S. does not, and all their debt in Japan is domestically owned. It's all denominated in yen and it's all owned. There's very little foreign, like the Americans don't own, Japanese debt, right? The Chinese don't own Japanese debt. Where the U.S., even though it's going down, has a very large portion of its debt. Like the Chinese and the Japanese own 2 trillion combined, just two countries. So a large portion of the debt is owned by foreigners, and foreigners are less likely to put up with, oh, you're printing all this money to bail out your own country. Foreigners are more likely to say, we're out of here. And we're getting no yield at the same time,
Right.
Yeah.
Well, what do you think are the investment implications of this going forward?
Well, you hate to just be like a gold bug and say, "Oh, just buy gold." But I think this is why when I look at this gold correction right now, from a macro I guess like I'm not too worried about it, because it's like you can't keep doing this, and debasing the currency and making it go lower, etc. From the stock market standpoint, when you get this inflation, and if this debt problem and structural problem of the government spending too much, the government becoming more socialistic. And I'm not talking from a political standpoint of being like, attacking the current administration. That's been going on for a while. I'm thinking more like structurally, that's what happened in Argentina after World War II. And Argentina since then has had these huge boom and busts and massive inflations. And we're kind of seeing that too, as the government is becoming larger, the economy is not as stable. We got the 90s tech bubble. We got the 2000s housing bubble. We got the last decade, because people call it the everything bubble. We're having these booms and busts, right? We're not having the 1950s, 60s kind of stable growth. We're having these like huge moves in the stock market and booms in the economy. And then these like the last, if you go look at it, going back to the 30s, after 1937, there was one bear market where the market dropped more than 45%. And that was 1974. Since then, we've now had two bear markets where that's happened, 2000, 2008, and it almost happened, last year in March. So the fact that in the last 20 years, we've had two of these, almost a third, and we didn't have any for 60 years, tells you we're seeing more of this boom and bust thing. And then of course that indicator, the stock market capped the GDP, which had only really reached near 100% once, 1929. It hit it in 2000, it hit it in 2007, it's hit it again. So again, we're seeing these more extremes in valuations on the upside and the more extreme busts on the downside. So I think that's another implication, that we're going to continue to see these more extreme boom and bust. And last thing about it though, and the bad part of this is, if you go look at the average working class person in Argentina, for example, like I just mentioned, their standard of living has been horrible since the 50s. Argentina was the third richest country in the world after World War II. Only Canada and the United States were richer on a per capita basis. And now Argentina is essentially just like, one of the poorer countries in South America. So even though these boom and bust are maybe okay for some of the elites in Argentina, the average person in Argentina has seen their standard of living, which was almost like an American or Canadian in 1947, gone to like that of a person in the third world today.
Yeah, we're in for some interesting times. That's for sure. It appears that it's slow motion, starting to see some changes leading to it.
Yeah. So, and again, this is another article from CBS News on the debt, right? So, and remember, actually, what's interesting about this article, it says right here that 202% of GDP doesn't even factor in the $2 trillion they just spent, and that $2 trillion is roughly 10% of GDP. So it's like that didn't even factor that in. So you can probably add that 202 to 212, just like that, So it's that's and then of course there's other things like unfunded. Actually, that's what last thing I'll talk about here. So we all know that people have talked about Social Security and all of this sort of things, and the whatnot. And so this is just a quick chart of it. That's actually the national debt. This is the government's fund liabilities. And you can see their liabilities, which were, really crazy in the 70s. It was still 500 or 600% of GDP. Actually, you can see there's private debt. This is everything. So this is Social Security, private debt, public debt, etc. Right? Well, let's just look at these two top here, which was about 200% of GDP back in the 70s. That's Medicare and Social Security. that is now basically about 600% now. And those are part of, the two main parts of the government budget as well. So again, to me, that means more inflation, because are they really going to do, no one's going to do the political risk of saying, hey, we can't pay you Social Security. We can't give you Medicare. What are they going to do? They're going to print money to fund that, which means that, okay, you still might get your $1,000 a month in your Social Security check, but it's not going to be worth anything,
Well, I think people in that situation, they need to invest in ways that will benefit themselves from future inflation.
Yeah. Look, and there's other things other than investments. I'm not a survivalist by any means, but if you wanted to, get a garden, grow your own food, stuff like that. I do live in an island where most of the food is imported. So I think stuff like that is probably prudent on top of, and let's face it, you grow your own food in your own little garden, tastes better. Like I have a pomegranate tree, it tastes 1,000 times better than a pomegranate you buy at the store. So, and I have some other vines and stuff. But anyhow, just other things like that. But yeah, I think you need things that are really going to keep up with inflation. So it's not just gold and precious metals, other commodities, et cetera, that sort of thing,
For sure. We've seen other commodity sectors do well so far in the beginning of this year.
Like another thing to be get a car that's efficient. Like one issue they had in the 70s was Americans had these big gas guzzling cars. And one of the reasons the Japanese started taking over the car market was they made these tiny little compact cars, which were way better on gas. And when the oil crises happened, that's what people wanted to own, right? So if all these things are going to inflate and go up in value, you kind of, have to do that sort of thing. But anyhow, yeah, mostly an investment standpoint, I would just look at kind of inflation hedges. And by the way, after some sort of bust in the stock market of corporate bonds, which I mentioned, I think the stock market will start going up with inflation too. But I just think we kind of, because we're such a frothy bubble right now, we kind of need that froth to come out. And then when that comes out, I tell Mike, we've had this discussion off air, just to end off here, this might be the last time I ever do massive shorting or last time for a long time, because I just think they're going to inflate things so much. It's going to be very difficult to short after this bubble burst,
Oh, for sure. Well, it was good talking with you, and I'll send this out to, the people following my stuff on my website too, once you get it posted.
Yeah. And last thing to end off, we kind of just wanted to talk about something more long-term and a little different. And last thing, I think it's really ironic that the debt is almost 8 times higher than where it was in the early 90s. And now no one is worried about it. So that's kind of one of the things I wanted to discuss as well.
Well, thank you for taking the time to talk to me and everyone else.
Yeah, thanks.